During the third quarter, one of the main factors was the Federal Reserve and its decision not to raise interest rates. The Federal Reserve is also not alone in that. We are seeing central banks around the world with a very accommodative set of policies that has led to over $10 trillion worth of sovereign bonds having negative yields, which is unprecedented. You have dividend-paying stocks, for example, that are providing an attractive income stream with the possibility of income growth over time, which also gives you a measure of not just growth of income, but also inflation protection if inflation were to come to fruition down the road. And with equities, you also have the potential for capital appreciation over time. In the third quarter, in terms of performance, what was noteworthy was the information technology sector, which had a good showing in the third quarter as investors became once again enamored with the growth prospects in the space. And also, many of the information technology companies are having very strong balance sheets and generating a lot of free cash flow. And the valuations in the space, on average, is still below the market average. On the flip side of that, during the third quarter, we saw the telecommunication services sector have mediocre performance as a result of very strong performance prior to the third quarter. In the long term, dividend growth tend to correlate strongly with earnings growth. But in the short term, and that can last for a few years, there can be a deviation. And the fact that the payout ratio was so low, combined with strong balance sheets, lots of free cash flow generation, and lots of cash on the balance sheets, have allowed companies to continue to increase the dividends, in some cases very meaningfully so, even though earnings haven't necessarily kept the pace. For the remainder of the year, we have earnings seasons ahead of us. We have an election cycle. We also have a potential increase in interest rates by the Federal Reserve, possibly in December. So those three factors are quite important and can increase volatility in the market, notably the equity market. Longer term, I remain very constructive on the portfolio and its positioning. The income need is very strong in our country, in the United States, and it's actually global. There's really not much income to be had on the fixed income side, and that's pushing investors in need of income up the risk curve and embracing equities, common stocks with dividends. And so for the long term, I can see the need for income stay with us for many, many years to come, if not decades, and that bodes well for the strategy that we're offering to our investors.